You could retire with millions in the bank and still run out of money. I've spent years helping successful families structure their ideal futures, and I've watched even the wealthiest investors fall into this trap. And once it starts, it spirals fast. Before you know it, your savings shrink, your options disappear, and it becomes nearly impossible to recover. So in this video today, I'll reveal exactly what this hidden danger is, and why so many people fall victim to it, and most importantly, how you can protect yourself before it's too late. To explain this risk, let me tell you a story about two different investors. Both retired with $1 million in their global portfolios in the great companies of the world. Both planned to withdraw $50,000 a year to cover their living expenses, and both experienced the exact same market returns over time, but there was just one big difference. The first investor retired in the year 2000. Markets had been soaring and confidence was very high, but within months everything changed. The dot-com bubble burst, and over the next 3 years, markets fell hard. Just as things started to improve, the 2008 financial crisis hit, wiping out even more value. By the time this investor hit their 70s, their once £1 million portfolio had been completely drained. Decades of their careful savings had gone. Now, let's look at the second investor. Same starting amount, same withdrawals, and the same returns. But instead of starting in 2000, they retired in 2023. Their first few years were very strong. The market kept on growing, their investments compounded, and their withdrawals barely made a dent. Even though this investor experienced the same ups and downs as the first one, they just got them in reverse order. They ended up with roughly the same amount that they started with. So how exactly is this possible? The devastating difference isn't about how much their investments returned, it's about when those returns happened. This is what financial experts call sequence risk, and it might be the most underestimated threat to your retirement security. Still not sure why this matters? Well, let me give you a simple analogy. Let's say you're drinking from a bottle of water during a long hike. You don't know exactly how far you've got to go, so the goal is to make sure that the water lasts right until you reach the end. If at the beginning your hike is cool and shady, you take small steps. Your bottle stays mostly full, and by the time it gets hot and exhausting later on, you've still got plenty left. But now imagine if you start the same hike in the scorching desert. You're sweating, you're losing water fast, you've got no choice but to take big gulps early on. Even though the rest of the hike might be easier, by the time you get there, the bottle is nearly empty and there's just no way to refill it. And that's exactly how sequence risk works. If you experience strong market returns in the early years of your retirement, your portfolio has time to grow and to sustain your future withdrawals. But if the market crashes early on, you're forced to withdraw from a shrinking pot, just like drinking too much water at the start of the hike. Even if the market recovers later, it's too late. Your portfolio doesn't have enough time left to bounce back. And this is exactly what happened to many investors who retired just before the tech crash of 2000. Their portfolios were hit early, and the combination of withdrawals and market losses made it mathematically impossible to recover. But this isn't just a theoretical risk. Imagine watching your savings disappear twice as fast as you'd expected. Imagine the stress of realizing you might run out of money in your 70s or your 80s and there's just nothing that you can do about it. Many retirees end up having to make painful choices, either living on much less than they'd originally planned or going back to work when they should be enjoying retirement with peace of mind, security. A big part of this comes down to how you personally approach investing and financial decision making. Many people naturally take on too much risk, whilst others play it too safe and miss out on growth. If you want to know which category you fall into and how that may affect your retirement strategy, take our free money personality test. You can find the link and how to do this in our description below. Fortunately, there are specific strategies that you can protect your retirement from sequence risk. Let me show you exactly what to do. The key to managing sequence risk isn't trying to predict the market. It's making sure that your retirement plan can handle any market at all. And that comes down to two key things. Firstly, a solid financial life strategy. And secondly, a robust investment strategy working together. Let's start with your financial life strategy or your documented financial plan. First, stress test your finance against different scenarios before you retire. Think about things like what happens if the market drops 30% in your first few years. What if inflation skyrockets and your withdrawals don't stretch quite as far as you'd originally expected? Running these types of simulations in advance will help you understand your true risk level and what adjustments might be sensible to make before it's just too late. Next, build flexibility into your future planned withdrawal rates. Many retirees still follow the old 4% rule, but in today's markets, being rigid can be a dangerous mistake. Instead, withdrawals should adjust based upon market performance, taking a little less in bad years and a little more when things are good. Think of it like setting guardrails for your spending. You have your essential expenses that don't change, but discretionary spending, things such as vacations, luxury purchases, and non-essentials should always just be flexible. And of course, none of this works if you don't stick to the financial plan or the life strategy. Emotional discipline is one of the hardest but most crucial factors in investment success. When markets dropped, it's tempting to panic, but history has always shown that investors who stay the course always come out ahead of those who try to time the market. Now, on the investment side, even the best financial plan can fail if your portfolio isn't built for the realities of retirement. Many retirees structure their investments the same way that they did when they were working, focusing only on growth. But in retirement, stability is just as important. The simplest way to protect yourself is to keep a cash reserve and a war chest of short-dated bonds. We typically recommend 3 to 5 years of living expenses in readily accessible low volatility assets, so you're never ever forced to sell investments during downturns. Instead, you can just ride out bad markets without locking in any losses. For instance, if investor A had kept $100,000 in cash or bonds at retirement and lived off that during the first 2 years of the market downturn, he would have avoided selling his investments at the lowest point. When the market eventually recovered, his portfolio would have been in a much stronger position, and he would have preserved over 40% more of his wealth by year 10 of his retirement. Your portfolio also needs to be properly diversified. Make sure you're not just holding US or other concentrated stock positions, but include global stocks and potentially real estate, given that cash, bonds, real estate, and stocks in all of the great companies of the world are the 4 key asset classes for sensible investors. And when downturns do happen, because they will, rebalance smartly. For example, let's say you start retirement with an 80% stock and 20% bond portfolio. If stocks take a hit and bonds go up, rebalance would mean selling a portion of these bonds and buying stocks whilst they're cheap. Whilst this is tricky to do when bombarded by news headlines, this means that you're buying low and selling high instead of panicking and making emotional decisions. But even the best investment strategy needs regular adjustments. Meet with your financial life managers at least annually to review your asset allocation. Make sure your portfolio is still working for your wider life needs and adjust it accordingly. Whilst you can't eliminate sequence risk entirely, if you take a few right steps now, you can protect your ideal future that you've worked so hard to achieve. But sequence risk is just one of many different retirement threats that most people never see coming. This is especially true if you're planning to retire abroad, where the stakes are often even higher. So check out this video next, where I reveal the 4 scary retirement truths every expat ignores before it's too late.